Hi everyone, in this video we will be going over A-Level Accounting 2022 February-March Paper 3-2 question number 3. This is the structured paper 3 which consists of 6 questions. All of them will be of 25 marks and we're also given a time limit of 3 hours, which means that ideally we should be spending about 30 minutes in order to solve each question. And in this video as well, we will be attempting to solve this question number 3 under 30 minutes. So without any further delay, let's get started. The statements of financial position for W Limited are as follows. We are given the statements of financial position for two different dates, 31st December 2021 and 31st December 2022. Okay, then we are also given the additional information. The cost of land and buildings at 31st December 2020 comprise of land 250,000 and buildings 400,000. The land which is not depreciated had been revalued to 330,000 on 1st July 2021. So this is just a revaluation upwards which has already been adjusted into our statement of financial position. Alright, then on 1st March 2021, a final dividend for 2020 of 0.20 per share was paid. Let's figure out the total dividend. So that is just going to be the rate per share times the number of shares. And we're told that an additional 200,000 ordinary shares were issued on 1st April 2021, which is after this payment of dividend, right? So let's have a look at our total ordinary share. We can see that before the issuance of new ordinary shares, we only had 400,000 ordinary shares. And this is because the number of ordinary shares is the value divided by nominal rate. And in this case, the value is 400,000, whereas the nominal rate is just given to be 1. So that gives us the number of ordinary shares to be 400,000. Alright, so let's multiply it with the rate of 0.20 per share. That will give our total dividend. So that is 0.20 times 400,000, which results in 80,000. Then we're told that an additional 200 ordinary shares were issued, and this brings in the total amount of 200,000 into our ordinary shares, since our nominal rate is also $1, right? Then on 1st September 2021, an interim dividend of 0.10 per share was paid on all shares in issue on that date. And the total value of shares on issue on that date is 600,000, which means that the number of ordinary shares for which we will be paying out this interim dividend is also going to be 600,000, right? So let's figure out the total dividend or the interim dividend. That is just going to be the rate of 0.10 times the total number of ordinary shares, which in this case is 600,000. And this results in the amount of 60,000. Alright, then during the year ended 31st December 2021, an item of plant and machinery costing 12,000 was sold for 3,000 at a profit of 2,000. Okay, we're already given the profit as well, so we do not need to perform any sort of calculations. And in the year to 31st December 2021, all interest due, 44,000, has been paid. So there is no interest due left. Okay. Now let's have a look at our first question. We need to explain what is meant by the term cash equivalents. So cash equivalents are the short-term, highly liquid investments which can be readily convertible to known amounts of cash. And these are also subject to insignificant risk of changes in value. So the keyword here is insignificant, which means that there are no significant risk of changes, since we already know the amount of cash. And these are the highly liquid investments, which means that we need to know the amount of cash that can be convertible at any point of time, due to which there is no such risk of changes. So let's write it down. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. This concludes the first part of this question. We can now move towards the second one. We need to prepare the statement of cash flows for the year ended 31st December 2021 in accordance with IAS 7. Alright, so this is the statement of cash flows for the year ended 31st December 2021. And remember that the statement of cash flows consists of three different sections. So the very first one will be that of operating activities, the second one will be investing activities, and the last one will be financing activities. So let's start with our operating activities. And we were given the amounts in thousands, so we can do that here as well. Okay, we'll start with our operating activities. And we always start with profit from operations. So let's have a look above at our statement of financial position. And remember that profits are always added to the retained earnings, right? And we can see previously the retained earnings amount was 109,000, whereas the retained earnings now is 136,000. And remember that we also paid out dividends, right, which are also adjusted in the retained earnings. So the most easiest way would be to prepare the retained earnings column. So I'm just going to write it right here. So this will be the retained earnings column from our statement of changes in equity. So we have our opening balance to be 109,000. Then we paid out dividend, which needs to be subtracted, right? And there are two dividends paid. So let's write those amounts as well. The first one was of 80,000 and the second one was of 60,000. We need to deduct both of these amounts. Let's write that down. So that's going to be 80,000 and 60,000. And then we add the profit for the year, right? And this is the amount that we need to figure out in order to figure out our profit from operations. So this is the profit for the year. And this gives our closing balance, which is again given in our statement of financial position right here to be 136,000. Now, in order to solve this, I'm just going to write this equation right here. So that's going to be 109,000 minus 80,000 minus 60,000 plus P equals to 136,000. So now we can easily solve for the value of P. That is just going to be 136,000 minus 109,000 plus 80,000 plus 60,000. And this results in the profit for the year ended 31st December 2021 is going to be 167,000. Alright, but remember that we require the profit from operations, right? And profit for the year is just the profit from operations minus all of our finance charges. So let's substitute the value for profit, that is 167,000. We need to figure out the profit from operations, and we're told that the finance charges are the interest, which were given to be 44,000 for this particular year, right? So we just need to subtract this as our finance cost, 44,000. Now this gives our profit from operations to have the value of 167,000 plus 44,000, which results in 211,000. So this is the amount we'll start with in our operating activities section. Let's write it down. So that is 211,000. Alright, then the next step would be to adjust all of our non-cash expenses, right? And the very first non-cash expense would be that of depreciation. Let's write it down. So the reason for doing this is that profit from operations also includes our non-cash expenses. So while figuring out the profit from operations, we subtracted the depreciation, right? But currently we're talking about statement of cash flows, which means that we do not need to include all of these non-cash expenses. And in order to reverse this effect, we just now add the same amount of depreciation as an adjustment. So let's have a look above. The non-current assets are land and buildings and plant and equipment. So let's first figure out the depreciation for buildings. We were given additional information. We were told that the cost of land and buildings at 31st December 2020 comprised of land 250,000 and the buildings of 400,000, and the land is not depreciated. So the only depreciation is to be done for this building of 400,000, right? So we can just look at our accumulated depreciation, which is given right here. So the accumulated depreciation in the previous year was 160,000, whereas the accumulated depreciation for this year is 201,000. Now we can just figure out our depreciation charge for the year by preparing a schedule. So our schedule starts as the opening balance for accumulated depreciation. Then we add all of the charges for the year. This is the depreciation charge for the year, which gives our closing balance. In this case, we have the opening balance of 160,000. We need to figure out this depreciation charge, and we also have the closing balance to be 201,000. So this just means that the depreciation charge for the year for building is going to be 201,000 minus 160,000, which results in the amount of 41,000. Let's add this in our operating activities section. So this is the depreciation for building, and that was of 41,000. Then the next step would be to figure out the depreciation for plant and machinery in a similar manner. We can see that our accumulated depreciation at last year was 274,000, whereas the accumulated depreciation for this year is 326,000. Let's see if we have any sort of adjustments to be made. Okay, right here, we are told that we sold an item of plant and machinery costing 12,000, and it was sold for 3,000 at a profit of 2,000. So let's figure out the net book value first. We know that profit is just the difference between the sales proceeds and net book value, right? And we're given the profit amount to be 2,000. The sale proceeds is given to be 3,000 minus the net book value, which means that our net book value is just going to be 3,000 minus 2,000, which results in 1,000. Alright, we are also given the cost to be 12,000, which means that we can easily figure out the accumulated depreciation, since net book value is the difference between cost and accumulated depreciation. So let's substitute the values. Our net book value is 1,000. Our cost is given to be 12,000 minus accumulated depreciation. So this gives our accumulated depreciation to be 12,000 minus 1,000, which results in 11,000. Alright. Now, again, there needs to be a slight adjustment in this schedule. Now, instead of just adding the charge, we also need to subtract the disposals. And while subtracting, we are actually subtracting the accumulated depreciation, since we are talking about the schedule for accumulated depreciation, right? And this gives our closing balance. So we have the opening balance to be 274,000. We need to figure out the charge for the year. We need to subtract the accumulated depreciation of disposals, which we just figured out to be 11,000. And this gives our closing balance to be 326,000. Alright, so this gives the depreciation charge for the year to be 326,000 minus 274,000 plus 11,000. This results in an amount of 63,000. So this is the amount of depreciation that we need to add in our operating activities section. Let's write it down. So this is the depreciation for plant and machinery. And this is for 63,000. Now the next step would be to adjust for all of our investing activities, right? And the investing activities just deals with all of our non-current assets. And in this case, we sold or disposed a plant and machinery. Right, so that is also to be a part of our investing activities. But remember, while calculating profit from operations, we either add the profit on disposal or subtract the loss on disposal, right? And in this case, we are told that there was a profit of 2,000 on this disposal. So in order to reverse this effect now, we need to subtract this amount of 2,000, right? So let's do that. That was profit on disposal of plant and machinery. Okay, the amounts are already written in thousands, so we do not need this. Now we need to subtract the amount of 2,000, so that's just going to be 2 in a bracket. Now we adjusted all of our non-cash expense as well as items relating to our investing activities, which means that now we can move towards comparing our current assets and current liabilities, right? We need to compare it and record whether there was an increase or decrease. So let's talk about assets first. Whenever there is an increase in asset, this results in cash outflow. And whenever there is a decrease, this results in cash inflow. So I'm just going to give an example. So increase in asset could be a purchase of asset, right? And whenever we purchase asset, we need to make a payment for it, which results in cash outflows. But in case of decrease, that would mean to get rid of an asset, right? Which can be termed as disposal. So when we sell an asset, we again get some sort of cash, which acts as our cash inflows. And in case of statement of cash flows, we always subtract all of our cash outflows and we add all of the cash inflows, which means that when we compare and figure out whether there was an increase, we should be subtracting that amount. And if there is a decrease in asset, we should be adding that amount. So let's talk about inventory. We can see that previously the amount was 89,000, whereas now the amount is 117,000. So there is definitely an increase. Let's figure that amount. That is 117 minus 89, which results in 28. So this increase should now be subtracted in our statement of cash flows. Let's write it down. That's an increase in inventory. And this is of 28. All right, let's repeat the same process. Then we have trade receivables. Previously it was 103, now it is 135. Again, there is an increase which needs to be subtracted. So that's 135 minus 103, which results in the amount of 32. Let's subtract this. This is an increase in trade receivables of 32,000. This concludes all of our assets. Now we can move towards our liabilities. So increase in liabilities will result in cash inflow. This is exactly opposite of assets. So decrease in liability will result in cash outflow. Again, I will be explaining it with an example. So let's talk about loan. So whenever there is an increase in liability, we could say that we took out more loan, which means that we brought in more cash into our company, which acts as a cash inflow. But let's talk about decrease in liabilities. That would mean a repayment of loan, right? And whenever we repay, obviously there needs to be a payment, which now acts as cash outflow. So after comparing, if there is an increase in liabilities, we need to add that amount in our statement of cash flows. And if there is a decrease in liability, we need to treat it as cash outflow and subtract that amount. So let's have a look at our current liabilities. We can see that for trade payables, previously the value was 120,000, whereas now it's 86,000, which means that there is a decrease which needs to be subtracted. So that's just going to be 120 minus 86, which results in 34. Let's subtract this amount in our statement of cash flows. So that's going to be decrease in trade payables. That was of 34. And the next liability was bank overdraft. And remember that we do not include the liability bank overdraft and asset cash in hand when calculating our statement of cash flows. When calculating our statement of cash flows, since that will be our final balance, right? So we don't include this bank overdraft. Okay, so this concludes all of our adjustments, which means that now we can figure out the cash generated from operations. So cash generated from operations. So the cash generated from operations is going to be the sum of these amounts and this amount. So let's first figure out the sum of these amounts. That will be 41 plus 63 minus 2 minus 28 minus 32 minus 34, which results in 8. Now, our cash generated from operations is just going to be 211 plus 8, which results in 219. Now, the final thing that we need to adjust in our operating activities section would be the finance charges and our tax. And in this case, there was no mention of tax, which means that the only adjustment to be made is going to be that of our finance charges, which was interest payment. So let's have a look above. We were told that in the year to 31st December 2021, all interest due 44,000 has been paid, which means that there has already been made a cash outflow of 44,000, and this cash outflow should always be subtracted in our statement of cash flows. Let's do that. So that's going to be interest paid of 44,000. This concludes all of the items to be included in our operating activities section, which means that we can now figure out the net cash from operating activities. That is just going to be the sum of cash generated from operations and interest paid, which in this case is 219 minus 44, which results in 175,000. Alright, now let's move towards the second section, which deals with investing activities. So this will be the investing activities section. And investing activities only deals with purchases and sale of non-current assets. So let's have a look above. We know that we sold a non-current asset, and from that we received an amount of 3,000. So this now acts as our cash inflow, right? So this amount should be added in our statement of cash flows under the heading of sale of plant and equipment. Let's do that. So we have sale of plant and equipment, from which we got 3,000. Okay. Then let's have a look above. We're not told whether there was an addition or purchases of new building or machinery, but we can figure that out by comparing our cost at these two different dates. We can see that the cost at 31st December 2020 for land and buildings was 650, and we are told that out of this 250 belong to land and then 400 belong to buildings. And later we are also told that this land value of 250 will now be termed as 330, right? Since there is a revaluation upward. So from the previous value of 650,000, we just subtract 250, that is the previous value, and add the new value of 330,000, right? So this would give the total cost to be 730,000. But we can see that the total cost at the date of 31st December 2021 is 1150, which means that there must be additional purchases of building, right? So let's figure out that building. That is just going to be the difference. So purchase of building is just going to be 1150 minus 730, which results in 420. So we bought new building worth 420,000. This is the new purchases, which means that while purchasing this building, we paid out this amount of 420,000, which is a cash outflow, which needs to be subtracted in our statement of cash flows. Let's write it down. So that's going to be purchase of building, and that was worth 420,000. Now we need to compare it similarly for our plant and equipment as well. So, alright, right here we can see that the cost of plant and equipment at the previous date was 454. And we know that we got rid of a plant and machinery which had originally costed 12,000. So we just need to subtract this amount of 12, right? Now this would give the new value for plant and machinery to be 442,000. But we can see that the new cost is 539, which means that there was again a new purchases of plant and machinery. Let's figure out the purchase amount. That is just going to be the difference between these two values. So that's 539 minus the value after disposal, which was 442. Now this results in the amount of 97,000. So we need to adjust it in our statement of cash flows. And again, this is a purchase, which means that we paid out this amount of 97,000, which is a cash outflow, which needs to be subtracted. Let's write it down. So that is purchase of plant and machinery worth of 97,000. And this concludes all of the items to be included in investing activities, since the only non-current assets were building and plant and machinery, right? So let's just add it and figure out the net cash from investing activities. That is just going to be the sum of these three amounts. That's 3 minus 420 minus 97, which results in a negative balance of 514. Now we can move towards our final section, which deals with financing activities. And financing activities deals with equity and non-current liabilities. So let's have a look above. Let's talk about equity first. We can see that the previous value of ordinary share was 400 and now the value has increased to 600,000, which means that there was an additional cash inflow of 200,000 in the form of ordinary shares, right? So that is an inflow of 200,000 which needs to be added. Let's talk about share premium as well. Previous value was 70, whereas the new value is 120. So there is an additional inflow, that's 120 minus 70, which results in 50. So the total inflow in the form of our share capital is going to be 200 plus 50, which results in 250. So you can remember it as an increment in ordinary share capital and share premium results in cash inflow. So we need to add this amount of 250 as proceeds from issue of shares. Let's write it down. So that is proceeds from issue of shares worth 250. All right, then we also calculated the dividend payments, right? And these are the dividend paid to the shareholders by the company, which means that for the company this is going to act as a cash outflow. So we need to subtract this amount of 80,000 as well as this amount of 60,000 in our financing activities section. So let's write it down. That will be dividends paid, and it's of 80,000 plus 60,000, which results in 140,000. And since this is a cash outflow, we need to write it as a negative balance. All right, now let's have a look at our non-current liabilities. And that was 12% debenture to be repaid in the year 2030. So previous value is 200, whereas now the new value is 150. So there is a decrement, right? And this decrement amount is 200 minus 150, which results in 50,000, which means that we just paid the 50,000 of this non-current liabilities. So this is a repayment. This is a decrement in non-current liabilities, which acts as cash outflow. So let's subtract this amount of 50,000. That is going to be repayment of debentures. That's of 50,000. All right, this concludes everything to be included in our financing activities section, which means that we can now move towards figuring out the net cash from financing activities. And that is just going to be the sum of these three amounts. That's 250 minus 140 minus 50, which results in a positive balance of 60,000. Okay, we have completed the three sections, which means that now we can figure out the net increase or decrease in cash equivalents by adding the net cash from operating activities, net cash from investing activities, and net cash from financing activities. Let's do that. That is going to be 175 minus 514 plus 60. And this results in a negative balance of 279. And since this is a negative balance, we can say that this is the net decrease, right? So the net decrease in cash and cash equivalent is of 279,000. All right, then the next step is to add our opening cash and cash equivalent. So that we can figure out our closing cash and cash equivalent. Let's have a look above. So we were given the previous year's statement of financial position, and we're just going to write down the cash and cash equivalents value from that. So that is 37,000. This will act as our opening cash and cash equivalents. Let's write it down. That's 37,000. Now, in order to figure out the closing cash and cash equivalents, we just add this opening balance to the net decrease in cash and cash equivalents. So that's going to be minus 279 plus 37, which results in a negative value of 242. Now, in order to verify whether our statement of cash flows is correct or not, we just look for this value in our bank overdraft section for this year's statement of financial position, since this is a negative balance of cash, right? Let's have a look above. We can see that for this year, we had the bank overdraft of 242. This just means that our statement of cash flow is correct. Now, this concludes the second part. Let's move towards the third one. Alright, we were given the working section right here, which means that you guys should be showing all of your workings in this particular box so that you get your markings correctly. Now, for the third part of this question, we need to explain two reasons why a business prepares a statement of cash flows in addition to an income statement and a statement of financial position. So this is because statement of cash flows provides additional information about how the business generates as well as uses cash. Let's write it down. Provides additional information on how the business generates and uses cash. And the second reason is because statement of cash flows is based on a cash basis, whereas the income statement and statement of financial position are prepared on accrual basis. Because if we remember correctly, while preparing the income statement and the statement of financial position, we need to record our prepayments as well as any sort of dues and adjust it, right, in order to figure out the profit for the year. But in case of statement of cash flows, we only record the cash inflows and cash outflows and completely ignore any sort of dues or prepayments. Let's write it down. It is produced on a cash basis, unlike income statement and statement of financial position, which are prepared on accrual basis. This concludes the third part. We can now move towards the fourth one. We are again given additional information. During a director's meeting, the finance director had asked why he had raised a bank overdraft to finance the acquisition of non-current assets. We now need to advise the directors whether or not the finance director was correct in raising a bank overdraft to finance the acquisition of non-current assets. This just means that we took out more than what we had in our bank account in order to fund the financing of new non-current assets. So we need to advise whether this was a correct decision or not by our finance director. So instead of taking out a bank loan or any sort of debentures, the finance director went with bank overdraft. So this could be the case because the time to obtain the bank overdraft is shorter than other means such as the debenture or issue of shares. Let's write it down. The time to obtain overdraft is shorter than other means such as debentures or issue of shares. And this also means that there is very minimal cost in order to obtain overdraft as compared to obtain debentures or issue of shares. Let's write it down. Minimal cost to obtain overdraft. Now let's talk about disadvantages of raising a bank overdraft. We are acquiring this bank overdraft in order to finance the acquisition of non-current assets, right? But this does not seem right, since the long-term assets should always be financed by long-term financing, but bank overdraft is a short-term financing. Let's write it down. Long-term assets should be financed by long-term financing, And the next one is that since the time to obtain overdraft is shorter and it also consists of minimal cost, the rate for bank overdraft is typically higher than the debenture or bank loan. And that could act as a disadvantage. Let's write it down. Interest rate of overdraft may be higher than the debenture or bank loan. Alright, now based on these factors, we need to advise the directors whether or not the finance director was correct. So personally, I would go with the decision that the finance director was incorrect solely based on the fact that the long-term assets should always be financed by long-term financing. Let's write the decision clearly. The finance director was not correct in raising a bank overdraft to finance the acquisition of non-current assets. Alright, this concludes the fourth part of this question as well as the entire question number 3 of 2022 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.